Welcome back to the second part of the Carbon Trust Corporate Sustainability Summit. I'm your host, Sasha Kadri. Before we begin our first panel discussion, just a reminder, please do keep your questions coming in for the speakers, and we'll try and get to as many of them as we have time for. Now, at the beginning of the session, we asked you a couple of polling questions, and I'd like to share the results. We asked, where in the world are you coming from today? Where are you joining us from today? And we can see overwhelmingly from the UK. I hope you can see that slide. We've also got a lot of people from London, Denmark, Switzerland, Mexico, Norway, and all parts of the UK. So delighted that you're joining us. We also asked, what sector do you work in? So food seems to be quite popular, retail, construction, government, energy, sustainability, of course. So yeah, a great mix of viewers today. So it gives me great pleasure to introduce our first panel. Well, introduce the moderator for our first panel. You already heard from him earlier today. So I'd like to welcome back to the stage Tom DeLay, who is the CEO of the Carbon Trust, and he is going to start off our first panel discussion. Over to you, Tom.
Hello there, good morning. And for those who didn't pick up my comments, it's a very warm welcome to this, our very first global corporate summit, taking advantage, sadly, of the very difficult situation we face with the COVID pandemic to nevertheless do something we've never done before, which is literally to engage on a global basis in a one-day event. The focus of which really is net zero, everything to do with net zero. And I did describe the situation we're in as being the result of sort of the Paris Agreement, the Greta effect, and now the COVID pandemic, all of which have played their part in creating where we are today. The Paris Agreement was a great opportunity for alignment between governments, between corporates and financial institutions. The Greta impact was very significant in engaging the future, essentially. A generation of people who will be the consumers, the employees, and the savers of generations to come. And lastly, of course, the impact of the pandemic, which has been very strange for anybody in the sustainability space. The momentum built up before COVID hit has largely been maintained. We've done some research globally, and it confirms that sustainability is no longer a nice to have, it's a must have for businesses, financial institutions, and indeed governments globally. The second, I think, is that there is an expectation that post-COVID, there will be a bigger pull on sustainability than ever seen before. That being the result of a combination of regulation, opportunities, I think, kicking in, and probably a reset of the economy in which people recognize that maybe things that looked as if they would have to wait and wait and wait can happen. Change can happen, and much faster than we've ever seen it before. So this first panel is all about green finance. It's a panel where I'm going to say as little as I can and simply moderate an outstanding group of panelists who are going to join us online today. I've got a few questions that I'm going to play into them, but please bring in your questions as well. We will have an opportunity before the end of the session to get to questions that you send in to us. And I know the panelists are geared up and ready to go on those too. So it's my great pleasure to introduce our panel. We've got Sir Roger Gifford, who is the chair of the Green Finance Institute here in the UK. We have Gim Huay, who is Managing Director of Sustainability at Temasek in Singapore. We have Dr. Ma Jun, who is the chair of the Green Finance Committee in China. And we have Anna Sweeney, Executive Director from the Bank of England. They are a terrific panel. I'm now looking down at them and hopefully they can see me or at least hear me. Look, we've got a lot of questions. I'm just going to do my best to fire them around and see where we get to. But before we go any further, green finance is something a lot of people have difficulty kind of understanding. And certainly everybody finds it difficult putting a definition around what green finance might mean. So I'm going to throw it as a first question to one or two of our panelists. Roger, what's your definition of green finance? Oh, Roger, you're muted.
Thank you, Tom. Great to be with you and very good to be participating. Congratulations on this event. And also, you're absolutely right about the speed of change. Green finance is very, very simple. It is the same as any other form of finance, whether it's a bond or a loan. It's the same maturity, same credit, same yield, but it has attached to it a specific environmental purpose, which is accredited and documented and followed through the life of the loan or the bond. It's otherwise exactly the same, whether it's a World Bank green bond or a World Bank non-green bond, same terms, same conditions, and normally same yield. In fact, on many secondary market prices, and now in some primary markets, bonds are coming at a slight premium because they are so attractive to investors. But in essence, again, no diminution of credit, no diminution of yield, I would say.
Roger, thanks very much. Dr. Ma, from a Chinese perspective, do you feel green finance is any different to that definition?
When I was drafting the Chinese green finance guideline, we debated on what kind of definition we should use. And we ended up with such a definition, which is financial services for economic activities that can deliver environmental benefits. Then we have to define the benefits, which include the 3 items. One is environmental remediation, for example, reducing air pollution, water pollution, land contamination, and secondly, reducing carbon. And thirdly, facilitating the circular economy, which is recycling of a lot of things.
Great, thank you. Anna, Bank of England perspective on green finance, does it have a definition?
I don't think we'd want to impose a definition. For us, the important thing is that banks and insurers that we regulate and are providing that form of finance measure and understand both the risks and the opportunities for the finance that they're providing in this space in the same way that they would with any other form of credit or investment. So it's understanding the green specific risks and opportunities and measuring them as equivalently as we do for existing credit and market risks, but recognizing that the green element provides that different type of risk that does need to be measured.
Thanks, that's great. And last, Gim Huay from Singapore, from a Temasek perspective, is green finance different from the finance that you work with day to day, or is it very much part of the Temasek thinking?
We've embarked on a journey to understand not just the broad definition, but also the taxonomy, the metrics, the reporting that's associated with green finance, right? Because it does require an allocation of resources and a certain understanding of how to label a business a green business, right? What falls within and what does not, and then how do you actually maintain that and report that on a regular basis, right? And we've started that journey with the view that this is a space that is growing, is very important. It could help catalyze a lot of changes needed. And the reason for trying to understand the space in relation to what is required of the taxonomy, the metrics and the targets is with a view that at some point we would like to be able to tap into this capital market space.
Thank you, that's great. I mean, I was keen to start with the definition of green finance and at least a bit of an outline, which I think we've achieved just now, because I recognize an awful lot of people dialing in today will have a corporate background, maybe some from governments or public sector organizations, and green finance is held out there as being a slogan, but it's actually an awful lot more than that. So I'd like to really spend the next part of the session trying to get underneath some of the challenges of green finance. And I think we'll start to get a better understanding of it if we do that. One of the questions that we've been putting to ourselves is all about sort of engagement and the level and process of engagement of investors in the real world. I mean, surely if green finance is to have the impacts that we've all just talked about, it's through translation into the real world and the real world creating a lower carbon future. So my question really is are we doing a good job in terms of investor engagement in the real world to ensure alignment with those outcomes? Roger, what do you think?
Yeah, I mean, I think we would see this in perspective. I mean, the UK, for instance, has been building environmentally beneficial forms of energy for the last 30 years. Much of that was financed with what effectively is green finance, but wasn't labeled as such at the time. And one has, I think, always with green finance, start with the investor. And because it's the investor that drove from the very first Swedish krona bond by the World Bank back in 2007, it's the investor that's driving this push towards the accountability and the transparency of what they are investing in. And it's why, exactly as Gim Huay was saying, it's a journey for many investors, but it's also about understanding what they're buying. So both sides of this discussion, the greening finance and financing green, I deal very much on the financing of green project side. Anna would be very much more on the financing of green, the taxonomy, the discussion, where there's been a tremendous amount of work done by the Bank of England on this. And I think we are in a stage of change where we're beginning to understand our technology better. Investors are definitely driving that, definitely driving the desire to understand better what the real risks are, what the science is behind this creature called the green bond. And by buying that green bond, they feel participating in a beneficial change, and it's according to their ESG portfolios, another phrase we can come on to in a moment, which is very important for those institutions as well. So it is a period of transition. Our Green Finance Initiative from the city was started only 5 years ago, and it's amazing how much has happened in that space. And I think in another 5 years, we'll look back, Anna and I from Bank of England, and think, my goodness, what a lot has gone on. It really has. But it will be investor-driven as much as anything else.
Yeah. Interesting. And you made reference there to the Bank of England, that clearly has done an enormous amount. As I travel the world and we talk about sustainability, the primary legislation that we have here in the UK that has enshrined net zero as a target out to 2050 on the back of the Climate Change Act is still seen very much as leading. There are a few countries that have now very similar schemes, and that's great, and the more the merrier. But the fact that our central bank has got so involved in this and has actually set out so much is again seen as very distinctive. Anna, I wonder if you could just share with us a little bit the journey that the bank has gone on to go from being a central bank that maybe never recognized sustainability as part of its job to being one that is actively promoting so much.
Obviously, the leadership of Mark Carney in this space has been instrumental, but it is now, as you say, it's now a core part of how we think about what our job is. And new governor Andrew Bailey is very clear that remains a really important part of how we think about our role in supervising individual institutions, and also thinking about systemic risk as a whole. Because I think the key for us is a recognition over the last few years that the impact of climate change, whether that's through direct physical risks or the transition risks that will come from public policy measures being applied to mitigate climate risk, have a real economic impact on the assets and liabilities of the firms, and therefore our core. It's the core part of understanding and managing the overall financial health of individual firms and the system as a whole, to understand and manage those climate risks. And we think that I recognize the word journey used earlier by colleagues on the panel. We think that is over a course of the last few years, and indeed still to come. We've made progress from sort of recognizing those risks, and we're now in the process of working out the best ways to measure those risks. And then the following step is then how to use that information, the taxonomies and the data and the systems that are being developed and need to continue to be developed, to take action then to make financial decisions about lending, about investing, which will then have the virtuous circle effect that we all hope.
Okay. Anna, thank you. That's great. Now, obviously, I'm interested also in the way in which this investor engagement can take part in different countries and also in very different systems and jurisdictions. Gim Huay, from a Temasek perspective, Temasek is government owned, but is an enormously powerful investor in this space. What's Temasek done in terms of investor engagement? Have you actually got down into the detail of what you're doing, or do you stand back with a taxonomy and say that's good enough?
No. We spent the last 2 years, actually it's now 3 years, engaging our colleagues as well as our portfolio companies around climate change. And the way we did it was to bring in the climate scientists, right? It was a process of getting everyone aware of what the issues are, right? And we brought in individuals who were able to speak to investors as to what was needed, what are the issues, right? So they were not just reading from the media, but they were having taste sessions that were tailored to their language. And last year, there was a commitment, right, top down, that we will achieve net zero as an investor, right, by 2050, and by 2030 to halve our emissions, right? And the reason why I emphasized the word top down was because it was not a consensus process to say, okay, where do you think we could get to, right? But it was more around the conversation that this is where we need to be. Let's find the various paths to get there, right? And the day we made the public announcement, my CEO made the announcement, all our portfolio companies started to reach out to us to say, first, are you serious? 2 is, okay, I need to work with you to make sure that I can also be aligned with where you're headed, right? So within our investee companies today, we've actually also publicly stated that we are not going to divest, but rather we want to engage them proactively to look at how we can help them reduce emissions over time, right? Granted that some of them will be in sectors like Singapore Airlines is one of the companies that we are a shareholder of. They are in very difficult to abate sectors, which is much part of a much larger ecosystem, right? So they will likely have to rely on other solutions, whether it's offsets or technological changes, right, to help transform their business model. So that engagement process started when the top-down commitment was made. And today, even as part of our investment process, we've integrated the notion of carbon pricing. And every investment, the investor groups will have to do a carbon analysis on top of ESG, right? I think it'll be difficult for them to get all the data on day one, but at least that journey has started. And even to have a conversation to say, look, what is the carbon footprint of your business? I think it's important to bring this into the consciousness of companies that we could potentially invest in. And alongside that, right, there are a few things where at the investment level, we need to help to drive change, which is really working with partners to look at longer term technological solutions, as well as investing into nature to see how we can close the gap, right? So that's the journey we've started on. Just in relation to green finance, it is an instrument, but I think the bigger story in the backdrop is really how do we get our carbon emissions down, whether it's through reductions, substitution, or absorption, right? And my hope as in this portfolio is really to be able to start looking across not just as carbon, but also at other ecosystem services, which is all part of the ecological makeup that supports life on Earth, right? But we start with carbon, right? We get that journey going, and hopefully within our lifetime, we can start to think about water, biodiversity, and so on and so forth. Yeah.
Thank you. Thank you. Dr. Ma, China's recent announcement is arguably the most significant announcement in terms of climate change and mitigation of the last year. China, carbon neutral by 2060 with peak carbon in 2030. How's that going to happen?
Thank you, Tom. I think definitely this is a very important announcement which will have profound impact on virtually all major sectors' development trajectory in the coming decades, especially for energy, transportation, and building. That's why after the announcement by our president on carbon neutrality target, every single ministry, every locality, and the financial institutions are all discussing what to do to implement the carbon neutrality objective. What I expect is that the energy sector will experience significant revamp in terms of its future strategy. The next 5 year and the next 10 years plan for energy transition will have to be speeded up because of this carbon neutrality pledge, and transportation green building agenda will be accelerated as well, and maybe by very large margin compared with the previously expected trajectory. And also within the financial sector, we are now beginning to discuss what the banks and the investors should do to facilitate this much faster transition towards cleaner energy, cleaner transportation, cleaner building. So impact will be profound, and you will see many announcements coming up in the next 6 months or so from various sectors, various local governments, and various banks.
Yeah, and Dr. Ma, in China, what's been the market reaction to those announcements? Were they anticipated? Is it something that's been welcomed? What's been the market reaction?
It was not anticipated by most people, but anticipated by a small group of people, including myself. And I certainly think most of the players in the green economy was very excited by hearing this new target. And I was just in a conference of wind power, and this conference gathered a few hundred companies today, and they are now announcing a target by themselves that's much more aggressive than before. So I think this kind of reaction is happening already as a result of the neutrality objective.
Thank you. Thank you. That's very interesting. I mean, it is a question of patient capital or of taking a long-term view. And I think there is a wide belief that not only will the signals given by the Chinese government, but also the likely commitment of that being really rolled out over time is something that is going to be very significant. Roger, market reaction in the rest of the world, London to start with?
I mean, I think it's been, if I can say it, it's been extremely positive. I mean, China, America, the Brexit, all the politics out there. One thing shines through for me in much of this is that we have a common area of discussion, a common goal to sort this, to address the challenge of climate change. And I have to say, I work very closely with Ma Jun. It's very good to see him on screen. In terms of discussing joint ways of best practice, joint ways of mobilizing capital into the market. So when China made this announcement, I thought it was tremendously exciting. They've given themselves a target. It's actually quite a tough target. It's only 40 years away, and all the people on this call over age of 50-ish will remember 40 years ago, 1980 wasn't very long ago. I still listen to all the pop music from the 1980s. So I think 2060 is really not a very far distance. It's ambitious, and I think the investor reaction will be to think, what does that mean for my portfolios? Where am I going to be investing? Interestingly, most international institutions are still underweight on Chinese stocks, if you look at the MSCI index. So there's plenty of scope for the right kind of stocks to be brought to Shanghai and Beijing markets. And I think we will see much more activity around that, particularly as the plans, as China's plans for net zero roll out. So I've only heard positive reaction. I think the banks are as excited as I suspect as the institutional investors are, but a lot will depend on the detail coming. What will the form of that energy be? What will the form of the transition be? And it's something we look forward to being involved with.
Yeah, Tom, if I may, just to add one example of the kind of reactions, is many local governments are now thinking about developing zero carbon communities as demonstration projects for themselves, so that more people can see zero carbon projects are actually feasible from technology perspective. In fact, we have searched in some European countries, there are some small zero carbon communities already, but in China, there are many localities which wanted to develop a much larger zero carbon communities in which every single building and all the transportation facilities and all the energy facilities are zero carbon.
Thank you. Just moving on to a related but different question, and the focus on how you actually make change happen most effectively. Almost a year ago now, Mark Carney, in talking about TCFDs, talked about the need to measure, manage, and report, and that this was going to be the basis of understanding risk and opportunity. And TCFDs have certainly gained a lot of traction. We've worked with organizations in preparing TCFDs and so on. But it does almost throw up a question. There is a school of thought that says you need to mandate TCFDs or their equivalent, and regulators should get on and actually focus on mandating that as a requirement. And then there are those who say, well, no, the regulation doesn't need to be mandated because there is investor pull. We'll make it happen because it's in our interest to make it happen. Anna, thoughts on the likes of TCFDs and regulation?
So it's not very often as a regulator that you get demand from the regulated community to increase the level of regulation. But I have to say this is one area where I do frequently get comments from CEOs and board members around the market that us mandating would be helpful. I think we probably think that that's right, but I think that the phasing of work so far, where it's a combination of the firms themselves, investors, and regulators working out what a sensible set of disclosures looks like, has been helpful. Sort of regulators coming in and charging in at the beginning and saying this is how to do it is probably not the best way to get to a sensible answer. So I think a combination of both investor pull and regulatory push is the best way to get to frequent and deep enough disclosures that will help people make sensible decisions.
Yeah, thank you. I mean, in China, Dr. Ma, do you see regulation or do you see investor pull? We've got now a big commitment from China in terms of decarbonizing the economy. Do you think regulation would help to enforce some of that and really make the signals land more strongly, or is it something the markets can deal with?
Sure. In fact, when we start thinking about building a green financial system, we compare with the UK and other OECD countries, and we found that most of the developed countries followed what we call a bottom-up approach to a green finance development, which means that it was largely driven by investors, asset owners, then pass the pressure to asset managers and on the corporates. Of course, it's changing in OECD countries as well, as the government and regulators are coming to give a much stronger push right now. But in China, we started off with a top-down approach. We recognized back 5-6 years ago that relying on the market player was not enough. It's going to be taking too long and too slow to drive the green agenda. That's why in 2016, we put out this green finance guideline, which included 35 measures from the government and regulators. That included the official taxonomy and official disclosure requirements, and some government and regulatory incentive for green finance. Now, back to your question on TCFD, we were moving from a voluntary disclosure approach for listed company back 3-4 years ago toward a semi-compulsory approach a couple of years ago, and now by end of this year, we'll have a compulsory requirement for all listed companies and all bond issuers to disclose environmental information.
Great. Yeah, it's a story, it's a journey that you've been on, and I've followed some of it with you. Gim Huay, Temasek, do you believe in regulatory drive, or do you think investors can provide the necessary pull and commitment themselves?
We're assuming it's going to happen. So we are not going to second guess the regulators, but it's a very good framework and provides a very structured way for the board and the management to understand the issues, right? So we've signed up to TCFD and we've also encouraging all our companies to do so and telling them that at some point you become mandatory. So it's much better that they give themselves time to warm up and get ready rather than to be forced into an unfriendly situation. So that's the assumption and the basis in which we are working.
And so we talked a little bit about regulation and the hand of the regulator in prompting maybe even voluntary action. The other way of looking at it, of course, is are there incentives and rewards in the real world? And can financial institutions provide incentives and rewards to corporates and others in the real world to invest green? Roger.
I don't like the word incentive because I feel it begin to ask governments for support. And I think this is simpler. It's like I think green finance is very simple. This is about risk and opportunity. And the risk is becoming clearer and clearer with great work on the taxonomy and on the definitions and on understanding, integrating the idea that there is climate risk out there into our financial decision making. This is enormously assisted by governments. As I'm very fond of saying, no one saw the auto stocks as climate risk stocks until governments decided that the models of diesel engines were not going to be any good in the future. So government, the combination of government and hard reality of real risk, physical risk change and environmental risk change, these are enough on their own, I think, to stimulate any intelligent investor and any intelligent corporate into thinking what their business model looks like going forwards. And I don't think we need incentives when you see the risk for what it really is. That may say I sound a bit simplistic. We rely in the particular city of London on hard-headed, cynical, conservative investors taking a very strong, firm look at things, often with a short-term approach to what they're doing. But they too can see that when governments change minds about particular industries or about particular trade routes or about how things are manufactured, they have to listen as well. So I don't know a single industrial customer of our institution that is not looking at their business methods, how they're producing goods, the energy they're producing, where the goods are sourced from, because they know that this can come back and bite them. And secondly, it comes back and bites them on the share price if they get it wrong and they have reputational damage. So I don't actually think there's any need for incentive.
It's interesting. I mean, certainly in some of the work we've done with financial institutions, we've seen a small green premium sometimes. And I have to say, a few basis points, not enough to rationally justify a shift, but maybe a signal.
No, absolutely. And indeed, we saw a massive issue from Germany, 2 10-year bonds from Germany side by side just 2 weeks ago, came 1 basis point through the curve. We've seen a number of institutions, including BNP Paribas, come last week well through the curve. It's not that it doesn't happen, but it's investor demand that makes that work. I wouldn't call that incentive so much as investor demand able to take a slightly low yield as a result of their demand for that stock.
Super. That's great. Thank you. Now, look, I believe we will have some questions. And Sasha, do you have any questions from the audience that we can put to our panel?
Yes, absolutely.
We have about 10 minutes left. Okay. And I do want to leave just a few minutes to give everybody a chance for a last comment on what's the one thing you would like to see happen in the world of green finance.
Okay, well, we've got actually a question here, which maybe you could put to the panelists, depending on what how you think it works out. Okay, on the financing green side, how can people and companies get more guidance behind choosing a bank which does not fund fossil fuels and instead is supporting green finance and yet have trust that their funds are safe?
Roger.
Thank you very much for that easy question. I think if you have to look at that, first of all, you can look at the rating of the banks, see if they're safe or not. It should be part of the UK deposit protection scheme, of course, and there are bigger and smaller banks. I think, personally, I think all the big banks are extremely conscious of this particular area. Their ESG language, their sustainability language is changing by the annual report by the year. So I suggest that if you're in the UK based, or if you're in most of France, Germany, certainly Sweden, you're looking at institutions that are trying very hard to make that transition themselves from one business model to another. And they will have statements about belonging to the principles of responsible banking, to the UN PRI. They may have made commitments about to get out of coal-fired, almost certainly out of coal-fired power. They may well have commitments on their oil and gas activities, their heavy carbon-intensive industry activities. It's worth reading the websites to see that language, because I think it's genuinely out there and coming, and it changes every few months. So onto the website, I'm afraid. But I'm pretty optimistic that you'll find a lot of good institutions that are in this space now.
One of the questions that is related to that is around the hard to decarbonize sectors, the coal, the oil and gas, the mining, the cement, the steel. And there is, it's a big challenge. The sectors are responding. Yesterday, or the day before yesterday, the IEA came out with a sector pathway for steel that was challenged very significantly by an awful lot of NGOs and others as being just not ambitious enough. It wasn't consistent with net zero as they saw it. So it's hard, and there is a sort of sense that it's so hard, let the sector sort it out, but then that doesn't come across as being sincere or genuine either. Is there a case for focused and collective action from financial institutions coming together to force change in some of the most difficult and sensitive areas? And Gim Huay, I'm going to bring you in on this one. There's an awful lot of coal and other hard to decarbonize activity in the real world in Asia.
Coal is an easy one because we've actually committed not to invest into coal. And right now, it's not difficult to persuade anyone not to go invest into new coal plants because the likelihood of facing stranded assets is very real, right? I think there are some sectors where it's a lot harder, like build cement, right, in the building industry. Right, it is responsible for significant emissions, right? But when you think about green buildings, very often it's just more focused on the operations as opposed to the embodied carbon, right, that goes into the manufacture process, which may not be always captured by the developers unless they look closely at their scope 3 emissions, right? The approach that we've taken is, well, all new investments, right? We need to be very mindful. What is the carbon footprint, right? Mindful that we are not just going to avoid investing into sectors that has a carbon footprint, because many of these sectors do play a different role in society. They may be providing core essentials to daily life. But the more important question that we want to ask is, one, is this entity carbon efficient relative to their peers? Two, do they actually have a pathway to reduce emissions, right? And if they don't, let's see if we can find a way to work with them to get there, right? So the approach that we're taking is actually more around proactive engagement. There are some companies, I mentioned Singapore Airlines earlier. We do have industrial companies, for example, companies that are in the renewable energy space, right? That also have fairly high carbon emissions, right, by virtue of the fact of the sector that they operate in. And really, today, the conversations that we have with them is, well, these are your emissions today. How do we get it down, right? Where are the technological solutions? How do we actually invest longer term to get there faster?
Thank you. That's great. Look, we're running out of time. I'd just like to go round literally in one sentence. Maybe each of you could think, what is the one thing that you would like to see change to promote green finance more broadly, to deepen its impact, to make those capital flows shift faster, and that we might look out for in the next few years? Dr. Ma.
Yeah, let me pick up your question on phasing out of fossil fuel financing. And I think three things are key to this process. One is the introduction of brown taxonomy, so that financial institutions will know how much exposure they have to fossil fuel and more generally to high carbon assets. And the second thing is disclosure. We need to move more quickly towards compulsory disclosure for these institutions to disclose not only to the regulator, but also to the general public how much brown assets they have. And thirdly is a capacity for environmental and climate risk analysis, so that these institutions will realize and will quantify the financial risks arising from their high carbon exposure.
Thank you. That's great. In a word or two, Hannah.
So the risks and the opportunities are real, and we mustn't hesitate and waiting for the perfect taxonomies and tools and data to measure before having a go and starting to take action.
Couldn't agree more. Roger, the last word.
I would like to see a greater emphasis or greater discussion around carbon tax. it's an obvious and a slight elephant in the room, but it's a no-brainer that we should look at bringing that in as a kind of direct way of promoting this and pushing this argument. That's the first thing. Secondly, I think that we will have a big focus going on from here on biodiversity loss and effect on land and on food, on water, and of course on the oceans. I think it's the next big area for green finance, blue finance, where you want attributable, purpose-led finance to be heading in. And I think we'll see a lot of that next year.
Lovely. And Gim Huay, one thing in the next year?
A bigger green premium.
Yes, I agree. It would help. But although I don't think the market actually relies on it, I think, as Roger says, we're seeing token green premium, not substantive. Look, thank you very much, all of you. It's been a fascinating panel. I'll be very interested to see the feedback from many people for whom green finance is one of those black box things that other people talk about. I think you really did bring it to life. We've challenged you to come up with comments on some of very diverse markets and approaches. But there is this common theme at the heart of it, that if we are going to make a transition to a net zero future, we are going to have to finance it. It's not going to be governments, it's going to be the private sector, and therefore reaching out and getting access to the finance is absolutely fundamental. So look, thank you all very much for your time. Thank you for coming and joining us today, and hopefully we'll all speak to you very soon. Thank you.
Thank you, Tom. Thank you,
Bye.
everyone.
Thank you.